a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
We're going to look at a new classification of ETFs now with our ETF Research Director, Nina Mishra. So this new classification is called Evolved Sector ETFs. What does that mean?
So we know that with technological advances, corporate business models continue to change. But traditional sector classifications, they fail to respond to these shifts because they are backward looking, and under traditional classifications, a single company can sit only in one sector. And now let's take the example of Amazon. I think Amazon is a perfect example of these changing dynamics. Amazon is an e-commerce giant, but over the past few years, the company has been expanding in other businesses too. Now, Amazon's cloud computing business, AWS, in the recent quarter, it accounted for 73% of Amazon's operating income. And last year's acquisition of Whole Foods and the more recent acquisition of PillPack, with those acquisitions, Amazon is now in grocery and healthcare businesses too.
So because of the diversification, they cross over into multiple sectors.
Exactly. So under GICS classification, Amazon is a consumer discretionary company, not a technology company, because the model is backward looking. So BlackRock came up with this new evolved sector methodology that uses artificial intelligence and machine learning techniques to respond to these changes. The methodology is more forward-looking, and a single company's market capitalization can be assigned to one or more sectors.
Interesting.
So taking the example of Amazon, in fact, if you look at the white paper on their website, you will see that Amazon's total market capitalization has been assigned to two sectors, 36% in consumer discretionary and 64% in technology. And it's an interesting white paper. I think investors, if they are interested, they should take a look. Now, we are discussing after these evolved sector ETFs, we are discussing two in particular today, which did really well in the second quarter.
Right. So the first one is from iShares. Well, they're both from iShares.
Both are from iShares. So we are discussing the technology evolved sector ETF and media and entertainment. Now we know that technology continues, the sector continues to do well. Companies continue to, do well. They have been doing well this year too. So no surprise that this is one of the outperforming sectors. And media and entertainment companies have also done very well of late. Netflix has totally upended the industry. And to respond to Netflix, there is currently a merger spree going on in the media industry. So that's why those shares have also done very well. So these are the two sector ETFs which they both made their debut in late March, I think 21st of March, and they did really well in the second quarter.
All right, let's take a look at the iShares Technology, Evolved U.S. Technology ETF first.
So the ticker is IETC. Now, all these ETFs, Evolved Sector ETFs, they are actively managed, and they use artificial intelligence and other techniques to assign the market capitalization of a company into one or more sectors. But even though these are actively managed, they charge a very reasonable expense ratio of just 18 basis points, which is reasonable for an actively managed fund. Now, these are new ETFs, so they haven't been able to gather much assets till now. A little more than 5 million in assets as of now. But investors should understand that liquidity is not a concern here, because ETF's liquidity is determined by the liquidity of the underlying holdings. And these ETFs, they hold very mostly large companies. So that's why liquidity is not a concern, but bid-ask spreads may be high because it's a new ETF, does not trade much. So using limit orders makes more sense if investors are interested in buying these ETFs, or they can wait for some time till they gather more assets are being traded in more heavier volumes.
Okay.
Now, if you want to look at the details and holdings, etc., you can go to the external homepage using the link on Zacks.com code page. And if we look at this Evolved Technology ETF, we see that Microsoft is the top holding with almost 13% of the weight in the ETF, and Apple, Amazon, Facebook, and Google are the top holdings in the ETF.
Okay, and now we'll look at the iShares Evolved U.S. Media and Entertainment ETF.
Mm-hmm.
Right?
So the ticker is IEME. Mm-hmm. Again, like the earlier one, actively managed with an expense ratio of 18 basis points, uses machine learning and AI techniques. And for further details of the ETF, you can again go to the external homepage using the link on Zacks.com code page. And here are more details about this ETF. You can look at the holdings, etc. And as expected, 21st Century Fox is the top holding. Disney, Netflix, and CBS are the next holdings.
Okay, so because they're relatively new, can we even compare them to the broad market?
Yes, so they were both launched on 21st of March, so that is why I have compared their second quarter performance, and both did pretty well in the second quarter.
Okay.
And I have compared that with the broader market, or SPY. So you can see that IEME was up more than 13% in the second quarter, and IETC was up almost 12% in the second quarter, whereas SPY, the broader market, gained about 5% during the second quarter.
All right, interesting. Do you own either of these?
I do not.
Okay, thanks for the information. And don't forget, there is more ETF information in the ETF section of Zacks.com. Use the Funds tab in the top toolbar on the home page to get to that section. And Nina also has an interesting podcast on ETFs on the podcast page of Zacks.com. With Nina, I'm Terry Ruffalo.